We're going to see if ADP was on track or not, and it was not. 209,000 on the non-farm payrolls for the month of June. 209,000. That is the lightest level, and I have to go on the way back quite a ways. That's the lightest level since Dece of 2020 when it was minus 268,000. If we look at manufacturing payrolls, they were up 7,000. The unemployment rate dropped from 3.7, and we all know that was the highest since Feb of 22. That was last month, to 3.6. So it moderated, but it's definitely still above the 3.4 that we had in April. And, of course, we understand that the unemployment rate is something that the Fed's going to pay close attention to. Average hourly earnings up 0.4%, hotter than expected, matches April. You have to go all the way back to July to see it up more when it was up 0.5. That was July of last year. And if you look at average hourly earnings year over year, they were up a whopping 4.4%. This is the new metric against inflation for many. It's the wage component, up 4.4%. It equals April. You have to go to February of this year to see it higher at 4.7. So even though it's come down a bit, it was 5% in November of last year, it is still definitely above the last several months, which was 4.3, 4.4, and 4.3, as you see. So we're hovering at that zone. And if we look at hours worked, 34.4, a tenth hotter than both what we were looking for and what was in the rearview mirror. Labor force participation rate, 62.6. It remains exactly on top of last month. And 62.6 is 1, 2, 3, fourth month in a row. And finally, the underemployment rate, known as U6, 6.9%. It pops 0.2. 6.9%. You have to go all the way back to August of last year to find a higher number at 7%. Interest rates have dropped. Matter of fact, prior to the number, we were hovering in a 2-year around 5%. Now it's at 492. And if we look at the 10-year, it was hovering around 406. It's now hovering at 4%. And we continue, of course, to monitor the equity markets. Usually when interest rates go down, the equity markets go up. And they did pop a little bit, but they're kind of right back to where they were. We need to continue to monitor. Equities have a lot on their plate. And just to summarize some things very, very quickly here. Gilt yields, the 10-year gilt in the UK is up nearly 30 basis points this week to the highest level since '08. Bond yields are up 24 basis points this week, a 4-month high. Our 10-year yesterday closed at an 8.5-month high. But here's the rub. You know, that 2-year note yield that reached up towards 5.11 yesterday, it failed to close above its March high yield close. It was March 8th, I believe, at 5.07%. As a technician, if we fail to close above that after trading intraday through it, especially on Friday, a weekly close, it's going to start to look like a double top. Is that horribly bearish? No, but it's something to pay close attention to because many believe we're going to start to see steepening, not necessarily driven by the short end, but maybe driven by long-dated treasuries, which may get stickier as we start to see the Fed get close to being done. And that is the dynamic because if you look at 2s to 10s at minus 90, it is definitely the flattest in, probably about 4 weeks, almost a month.